to
Why
keep
are there
it
no
simple.
bids?
No confidence, no confidence of what's going on, specifically policy-wise in this country.
Represents a significant buying opportunity, particularly for China, who does not give a crap about anything that the U.S. State Department or Commerce Department does with regards to sanctions.
Really need a recession and unemployment to tick up to even start denting inflation going forward.
18 months after the Fed has started tightening, the money supply is shrinking, and people can't get enough stocks to buy. Hello, where have you ever heard don't fight the Fed?
Could architect a recession? When would it happen to be the most politically ideal for a presidential year?
Right now.
Hi, everyone, and welcome to the Week Ahead. I'm Tony Nash. Today, we're joined by Ross Kennedy, Michael Belkin, and Albert Marko. Quite a lot happened this week on the geopolitical side, so we're going to start there, and we're going to move into markets. The key themes this week, first, are supply chain risks, looking at Middle East conflict. We're also looking at geopolitical dovishness, or the possibility of that. And then we're looking at risk or recession, which one is back on.
Shout out to the Week Ahead viewers. We've got an exclusive CI Markets deal just for you. Get 40% off our prepaid annual subscription. That's a limited time deal, bringing the price down to just $300 from the regular $500. Visit completeintel.com/save200. Use the promo code SAVE200 at checkout. This deal is designed to supercharge your investments, and it's our way of saying thank you for being a part of the Week Ahead community. Visit completeintel.com/save200 today and use the promo code SAVE200.
So Ross, thanks for coming on again. It's a great week to have you on. I know you've probably had a lot of discussion with your clients this week, given the current level of geopolitical risk. So given that, does the U.S. have the supply chain capability to weather the storm of the current geopolitical environment, or potentially even more intensive geopolitical environments?
For short answer, yes and no.
Good.
And it's really scenario dependent, right? Like any good analyst, it's there's a wide range of outcomes that you look at, and you say, what's my confidence that one scenario will emerge versus another? As things stand right now, we're talking about a significant amount of naval traffic and activity happening on water. Of course, primarily very close to the Suez Canal. There's obviously already been a significant amount of disruption to particularly the grains and the energy supply chains coming out of the Black Sea region. Since the Ukraine-Russia conflict kicked off February last year. So in a sense, you do have a bit of a 1-2 punch. A lot of it comes down to what happens next. We saw these just really horrific, videos and accounts emerge over the weekend, seemingly out of nowhere. Depending on the story, Israel was either caught, flat-footed in some way, or there were some other factors potentially at play. But at the end of the day, the claim that the situation is contained now, this does follow patterns that we've seen in the past. Certainly, to my criminal mind, if you will, you could easily be seeing a situation where you have a surprise attack, you suck allied and other assets into the region with the intention of creating more significant, widespread follow-on destabilization. So in a scenario where Hezbollah begins, emptying their pretty substantial arsenal of anti-ship missiles, and making it rain in the Eastern Med, now we have a real startling situation. Egypt will do everything they can to avoid a closure of the Suez Canal. They've deployed, or called up, very significant portions of their military to ensure that scenario doesn't happen. But the Sinai has not exactly been the most stable either. Going back 20 years, it doesn't get a lot of press here in the U.S., but that's certainly been a challenge, if you will. And then given the conflict between, ISIS and the Sinai, Hamas, very much at war with one another too on the border region of Gaza and Egypt. It is a powder keg.
Okay.
Right? So
if we assume that the situation stays as it is right now,
Mhm.
Israel and Hamas, West Bank, that sort of thing, and there isn't a wider conflict,
Mhm.
are there issues with, say, ags and supply chains and other stuff? So it stays local. Is that risk fairly contained? I know that's a big assumption to make, but
Sure.
we see the terrible footage on the news, our heart breaks, but does that impact supply chains, agriculture, energy, that sort of thing?
Not to a great extent.
Okay.
Crude certainly won't be, I guess, in my view, that impacted. Certainly the disruption we've already seen to the nat gas fields in the Eastern Med is a major challenge. That's something that other players in the region, whether it's Turkey, whether it's Saudi Arabia, Israel, Egypt, all of them have some skin in the game, particularly on the nat gas issue. So we could see some, potential disruption there, even if hostilities don't escalate further. Infrastructure becomes obvious targets in the event of a larger theater-wide escalation. And that's really where we go kind of from 0 to 60 on the risk
Okay.
calculation. As it stands right now, not bad.
Okay, so let's go to that. So we go out concentrically. Now, you don't have to go too far to have major issues. First is you go north, and let's say Hezbollah gets involved in the north. What are the issues?
Well, you're talking about certainly a significant disruption to commercial maritime traffic in the region. All risk and, insurance on vessels and war clauses and things like that only go so far. So you're certainly, I think, going to see a lot of commercial carriers elect away from, obviously port calls in Haifa, Alexandria, Piraeus in Greece. And that's just as the situation stands now. If we're talking about a really significant disruption to maritime traffic in the Med, you don't have to blockade the Suez Canal to begin to see a significant portion of freight that moves on water through that corridor, whether it's grains going south, crude going north, certainly manufactured goods, out of the Indian subcontinent, things coming out of Africa that tend to move north. That two-way traffic slows even if you don't close the canal, just by virtue of the risk inherent in the Med. The other shoe I'm almost kind of waiting to drop on the premise that a lot of this is sponsored by and organized by Iran.
Hold on. Let's not go there yet. Not go there yet. So let's not go to Iran yet. Let's just stay on the north. So when you talk about if things escalate north of Israel, that can have significant impact on the Med. So we saw, for example, say grains coming out of Ukraine kind of restricted because of issues with Russia, Ukraine. Turkey really tried to get that trade moving. How much of an impact could Turkey have if things go north and you start to see issues in the say the northeastern Med?
Turkey gets negatively impacted by the fact that most of their major commercial ports from where they export a significant amount of heavy equipment, minerals, manufactured goods, for the industrial, for industrial uses. They do face a risk there. Turkey benefits, though, opportunistically from the ability to pretty expediently open overland corridors to and from the Black Sea, being able to provide some level of guaranteed safe transport away from the risk of conflict in Lebanon and Syria, and being able to get things on water if they can, obviously defend their own waters, as it will, and provide that safe passage north of Cyprus between Greece. On net, I say Turkey probably has the ability, if they play it smart, to benefit more from this than less, or be negatively impacted. And we've seen they've been pretty savvy over the last 20-something months at how they've managed the Black Sea corridors, by using the Montreux Convention.
Absolutely. It's really easy to forget the impact that Turkey can have if things go north, right? But they actually really do have a lot of impact. Now let's go southwest, okay? Let's say things boil over into the Suez nightmare scenario. So what happens then?
Well, at that point, you're talking about anywhere from 10 to 12% of everything manufactured in the world transits the Suez Canal every year. You're talking about 30 to 50 vessel passages a day going through there. there's really two kind of key domains that I'm looking at there from a negative impact standpoint, because oil and nat gas have the optionality of pipelines at some level through Saudi Arabia up into Egypt. You know, Turk Stream is always available as well. So from an energy standpoint, it's probably not as crippling. However, Saudi Arabia does have a pretty significant amount of extraction and refining and transload capacity to bulk carriers, you know, on their western shores, which is inside the Red Sea. At that point, those vessels get redirected. Flows begin to redirect as well, anything that's moving north. There's also the issue of food in Africa in particular. We saw that and have continued to see that be a pressing issue from a food aid standpoint, because so much of that traffic moves to the Suez and, you know, terminates in the Horn or in the Red Sea. The third challenge is going to be to the Indian subcontinent. The Suez is the major corridor for trade between India and the Middle East, India and Europe, and India and the United States. You're talking about Navies, one of the largest container ports. It's right outside of Mundra. You know, and all of Southeast Asia or the Indian subcontinent is located there. 90% of something its vessel traffic is going to go that way. It's going to move, you know, northwest into the Suez. So India has some real skin in the game on this issue too, not only because of its connections commercially and from an energy standpoint to Iran and to Russia. You know, Iran's more tenuous. They're pretty tied at the hip to Russia in a lot of ways. So India's calculus in this is that right now they lose the IMEC for sure, the India-Middle East economic corridor. That's a dead letter at this point until things change. But for them, a significant amount of their export trade is with Europe and with the United States, and they face a dramatically negative impact because the only alternative options are things like double transshipments of containers through Singapore. You go west, you're talking a 60-day transit now versus, you know, about 35, or they have to go around the Cape. You know, and you're talking adding 10 to 14 days to your vessels there too.
Yeah. This part is fascinating. So talk about Turkey's impact if things go north, talk about India's impact if things go down to the Suez. India has positive relationships with Iran. They have positive relationships with Israel. They have positive relationships with Russia. So they can pull some strings. And I think the US in particular needs to stay close to India on this issue, and Turkey, of course, so that, you know, all of this stuff can be positively impacted, right?
Heads up for a short break.
Are you using the potential of AI in your portfolio management strategies? With an impressive 94.7% forecast accuracy on average, you can confidently integrate AI into your approach with CI Markets. Visualize the potential volatility of your portfolio over the next 12 months and gain insights into specific assets that might experience fluctuations. This empowers you to make informed decisions on when to buy, sell, or hold. CI Markets covers a wide range of over 1,600 assets, including stocks, commodities, forex, indices, and economic indicators. Imagine running limitless portfolio scenarios to optimize your gains. Curious about the outcome of removing or adding certain assets? Wondering how your portfolio might evolve in the next 3, 6, or 12 months? CI Markets equips you with answers to these crucial questions. Whether you seek a streamlined portfolio analysis, wish to explore diverse scenarios, or aspire to track your investments with precision, CI Markets is the ultimate tool for you. Ready to learn more? Visit us at completeintel.com/markets.
Thank you. And now back to the show.
So sticking specifically with the Med, can you talk to me a little bit about, I heard you make some comments about the US being dependent on kind of European commercial navies for activities in the Med. Can you talk a little bit about how the US doesn't really have the capability there to move things if needed?
Absolutely. I mean, at one time, particularly sort of in the first 20 to 30 years of PAX Americana, you know, we had the largest commercial fleet in the world. And, you know, we were a shipbuilding powerhouse. Liberty ships taught us how to make vessels that can move fairly fast and carry cargo. You know, quantity has a quality all its own. We've really eroded that advantage with the advent of steamship lines. You know, we begin to optimize more for outsourcing. And so our shipbuilding capacity, our maritime sea lift capacities, so vehicles, manpower, all of that has eroded, not just the commercial fleet, not just the tanker fleet. We're a shadow of what we once were. And so the reference to commercial navies is really the big three ocean carriers in the world are MSC, domiciled in Geneva, but owned by an Italian family, the Apontes, and then Maersk, based in Denmark, and CMA-CGM based in France. And given that, in the case of, MSC is really kind of an independent player, but certainly Maersk and CMA are major participants in U.S. maritime trade. Significant parts along with Hapag-Lloyd out of Germany of our, the auxiliary, essentially our ability to call up U.S. flagships with these carriers and press them into service. But to the extent that we have the ability to kind of have the option to the optionality to be able to put our own stuff on ships with our own sailors, we don't really have that, not at any kind of scale that can, defend the supply chains of the U.S. from major disruption, particularly in the Med.
Okay. Before we get to Iran, because I know that's a sweet, juicy thing that you and Albert are going to dig into. Hey, Michael, what are you seeing in terms of transports? Like, does it look like appealing to invest in European transport companies, or is there too much risk there?
I'm kind of agnostic. So I'm not familiar with some of the names that he just mentioned, but is in terms of global shipping, Maersk and Hapag-Lloyd are the two big ones listed in Europe. They're shorts for me, but kind of not very high confidence. But that's something else. That's not Mideast. That's just global trade is not doing well, and freight rates are falling, and ships are not being booked as heavily. So
perfect.
Kind of agnostic, but slightly negative on the only shippers I follow.
Okay, perfect. That's great to know. Thank you. Okay, so Ross and Albert, given that these aren't major oil and gas producers, but we also have the US SPR at a very low level, and we have Iranian crude exports that have been kind of accelerating over the past couple of years. Aside from the $6 billion that was announced, I think earlier today, that the U.S. is going to hold back with the Qatari government, do you think there's a possibility of seeing new sanctions on Iran? Is that a possibility, and what would have to happen for that to be a possibility?
I do think new sanctions will most likely be enacted by the U.S. on Iranian oil. Do I think it's going to matter much? Probably not. I mean, they do ship-to-ship transfers all the time by turning off transponders. God knows how much oil they mix in Basra with the Iraqi crude. So, sure, we can pay lip service to that, but I don't think it's going to make much of a difference.
Ross?
Yeah, I'd concur with as much as I love a good fight with Albert or anybody else. I'd probably lose. But certainly on both the premise and I think the just the factors that are in play here. Do I think sanctions are coming? Yeah, absolutely. It's an absolute layup for an administration that's been rightfully dragged through the mud over the fact that they released $6 billion in funds to buy 7 Americans back. It's the obvious go-to move. It's kind of the last option, not a very creative one, but it's kind of the last option. But Iran has already demonstrated, like Russia, significant capacity to actually move sanctioned material. But more than that, it represents a significant buying opportunity, particularly for China, who does not give a crap about anything that the U.S. State Department or Commerce Department does with regards to sanctions. So
right.
I think it's inevitable if we sanction them. All we do is we simply depress the price of Iranian crude and increase the amount that we will see moving between Iran and the Pacific Rim.
I mean, crude's on sale for Asia, right? Most Iranian crude goes to Asia anyway, right? India, absolutely. China, other places.
Yeah. I'm actually more keen on finding out what Turkey is going to end up doing with Iraq, since that oil pipeline has actually been blocked to the Mediterranean for many reasons. They say earthquake, the other ones say a lawsuit, but it's many reasons. I think that thing's going to probably be important in negotiations going forward, especially in terms for the crude oil market.
Interesting. So an Iraq-Turkey pipeline.
Yeah, well, they already have it, but the they shut it down because of lawsuits.
Okay.
It's interesting that Albert, I'll interject real quick. It's not quite on script, but there is a real dark horse factor here with the broader Kurdish population that occupies that region. It's the only population that is spread out at scale in Iran, Iraq, Turkey, and Syria. And yes, there are factions within it and all of that. And yes, to some extent, they're insulated from the larger conflict to the extent they don't get sideways with one of the main governments. But the ability of these very substantial Kurdish minorities in all of those countries definitely could impact anything from a logistics and supply chain standpoint, certainly that has to transit on rail or transit over land. They sit right in the middle of the new Silk Road corridor that China and others have been cooperating on to connect Chinese trade on land through the Eurasian through the Eurasian continent. So that definitely bears watching, because depending on how each of these parties responds, the calculus of the Kurdish populations in these countries changes too.
Interesting.
Yeah, a lot of the oil is out of the Kurdish area right now because the pipelines are shut down. Is trucked back and forth into Turkey and whatnot. But like you said, if the Kurds decide to act up, that'll get shut down pretty quickly. So those are definitely something I wish you didn't say anything about the Kurds. It's a whole Pandora's box.
Yeah, maybe we can do a special segment on that.
And I really just
that's its own episode.
I want to allow Michael Belkin to actually talk today.
Right, exactly. Okay, guys, let's get into Albert. I've been wondering, given what we saw the Fed and Treasury say earlier this week within the context of these events, we saw Fed speakers out early making very dovish comments early in their week. But we also saw elevated PPI and CPI reports this week. Yields fell for most of the week, but then came back up later in the week. So what's ahead, given the geopolitical backdrop, and given what we're seeing with CPI and PPI and other prints? And then we saw some consumption data out today where consumption is down, US consumers. What's ahead for Fed and Treasury activity, and how do they kind of balance this?
How do they kind of balance? They haven't been able to do anything properly in the past, so I don't even know how they're going to be able to balance this. I mean, the auctions have been absolutely atrocious. They obviously knew what CPI and PPI and the Michigan sentiment was going to be, because they had every single person they could throw out into the media, say inflation is over, like Krugman and whatnot. It was a success. So they know what they've been doing. They know that they've been making mistakes. And Yellen, I think like 2 weeks ago, was at a staff meeting, screaming of why isn't the bondholders paying attention to problem? Why aren't they listening to me? Well, you got a geopolitical event, and now they're going to listen to you. And the auctions aren't good. The economy is certainly not good. Inflation's starting to kick back up no matter what they do.
So sorry, let's go back. You said the auctions aren't good. Can you walk us through that?
Well, there's no bids in the bond market, especially the long bonds. Nobody wants them at the moment. It's just there's no bids. The only people that are bidding on it is the government itself.
Why are there no bids?
No confidence. No confidence of what's going on, specifically policy wise in this country. Okay. Why would you bid on it?
Okay.
So I mean, from there, it's just like I don't see how we get out of this situation without a recession, and a pretty sizable recession. And I know they talked about soft landing and whatnot, but they're going to really need a recession and unemployment to tick up to even start denting inflation going forward.
Okay. In the background, I've been seeing headlines of company X lays off 1,500 people, company Y lays off 5,000 people, other things. That seems to be happening pretty quietly so far. We're not really seeing the recession word too much out there. Given where those consumption numbers that came out today, and given the need, I hate to say it, but the need for a recession, do you think that the news of layoffs will be more prominent in headlines so that we start to see the table set for some of these Fed and Treasury actions to really be appropriate?
I really think that a lot of the corporations are trying to slow walk these layoffs because they don't want to catch the ire of the Biden administration calling them. And arguing a wider length off people. But I just think that the margins, because of wage inflation just getting out of control, is going to take over to the point where companies are going to face either bankruptcy or laying off workers, and neither one of them are a good good thing to happen and going into an election year. So I don't know who wins, to be honest with you, until I see earnings start dropping and unemployment go up. I don't see how the economy is going to be able to get itself right.
Okay, so if you could architect a recession, when would it happen to be the most politically ideal for a presidential year?
Right now, before Christmas.
Right now.
Yeah, right now,
Okay.
going Q4, maybe into Q1, and get it over and done with, and try to rally the markets and the economy going into the election. That's what I would do if I was an
Okay.
architect.
So Q4, Q1 recession. Again, we're not saying this is going to happen.
No,
This is
no.
saying in your ideal plan,
In my
Q4,
idea,
Q1, Q2, new stimulus plan, Q3, it gets out there, it's in everyone's pockets, and then election, everyone's happy, right?
Yeah, then
That's your ideal runway.
that would be an outline that I would play.
Okay. What do you think will actually happen?
I think they're just going to try to maintain the facade that the economy and the market's doing great, and slow walk it into a soft landing. And I think at some point something's going to break where it just gets out of control for them.
Okay.
Whether that's in 2024, I don't know, but certainly after the election they're going to have problems.
Okay, great.
Heads up for a short break.
In the fast-paced world of investments, staying informed is the key to success. Introducing CI Markets Free, your source for AI-powered forecasts. With our free version, you get access to powerful tools that help you make informed decisions. Join a community of savvy investors. Analyze market trends. Plan your investments strategically. Stay ahead with monthly forecasts, compare assets effortlessly, and download data for your analysis. Don't just take our word for it. Our users love the valuable insights CI Markets provides. Get started today with CI Markets Free. No credit card required. CI Markets, your source for AI-powered forecasts.
Thank you. And now back to the show.
So speaking of things breaking, Michael, let's get into some data and kind of whether we're looking at risk on or recession on. You've told us for a while that the technology trade is pretty played out. We saw shares like Meta earlier this week just rise pretty dramatically. They were all-time highs, I think, on Wednesday or Thursday. Why the pop this week? What's happening there?
Okay, good question. Let me just set the stage here. So,
Right.
Okay, so the consensus believes that inflation and higher interest rates are the biggest threat to the stock market. I think that's over. The downward impact of monetary tightening on the economy is arriving with a 19-month lag. The U.S. money supply, M1, is declining at a 10.5% annual rate. That's the biggest ever on record in Federal Reserve data. Same thing in Europe. European M1 declining at a minus 10.4%. That was the chart. We're probably going to show that.
No, chart's up on the screen.
Okay, so these M1 money supply declines suggest central banks are driving economies into a depression, not a recession. I mean, this is 1930 kind of stuff. And blowback is the unintended consequences of a policy mistake. The 9% CPI inflation rate and 11 Fed rate hikes are blowback from unnecessary stimulus that they did in 2020, COVID stimulus, way overdid it. The blowback we are about to experience is an economic slump caused by monetary and fiscal tightening that they imposed to rectify their previous policy error. It's a doom loop of overreacting to previous policy mistakes. The stock market investors are so far from realizing this, it isn't funny. Wall Street robot trading machines and individual investors firmly believe central bank interest rates cuts are bullish for the stock market. Nothing could be further from the truth. In the last two major Federal Reserve rate cut campaigns, that was starting in early 2000 after the tech TMT bubble, and then 2007, the credit bubble, the S&P 500 fell by 50%, more than 50% from peak to trough, while the Fed was cutting interest rates. Why? Because the economy and corporate earnings collapse in recessions. Tell that to the algorithms this is how I'm actually, finally getting around to answering your question here, who dominate day-to-day stock market trading. Those who program the algos seem to have skipped the stock market history class. The ingredients of a global risk-off move in financial assets are falling into place. In the last few weeks, emerging market currencies, EM debt, EM equities, junk bonds, and cyclical stock market sectors have toppled. The Israel attack comes at a vulnerable time. This was already happening before that. And so let me be a little more specific here. So one of my clients is an alpha captured fund, okay? And I hate to boast, but it's a reality check because they have 170, 180 contributors on there. I was number one in last quarter, up 19%, market neutral. I'm also number one right now. It's a moving target, up 4%. And what I am short crappy tech stocks. Okay, not so much Meta, but the Shopify, these really overvalued software stocks. Carvana, I mean, that has heavy short interest, but the list goes on and on. We don't have time for the whole list. I don't want to disclose it, but we have 50 positions on there. So, and what it tells me, the reason I say that, again, not to boast because boasting comes before a fall, but I can tell like what everybody else has on my competitors in this alpha capture fund. I watch my ranking go up and down according to the market. So earlier this week, I was down, 10, I was number 10 or 20 or something. And I saw all these others. So what I know is it's a feeling of consensus. Everybody's still buying this same crappy stocks, the same stocks that blew up Tiger Global. Of course, they're buying the Magnificent Seven and everything too, and those aren't going down that much yet. But so beneath the surface, these lousy tech stocks are going down, and I think they're shorts. So this is not a quick flip for me. I think I've been saying this for a while. These positions are on. I think you should be shorting on bounces like we had earlier this week. Sell and short. Don't get squeezed and say, "Oh God, it's going up. It's time to cover my shorts. I need to go long." That's a trap. I think the market's going down big time. And just a final note on that. So I was hired into Salomon Brothers. So my background came out of UC Berkeley Business School, Stat Department. I developed, everything I do is based on this quantitative model algorithm that I developed, which is a forecasting model based on time series analysis. And so I was hired into Salomon in 1986, right before the 87 crash. So in 87, what happened is the bonds sold off. Greenspan came in as the new Fed chairman, raised interest rates. The bonds sold off about 24%. The stock market went up all summer, peaked in August, sold off, rallied back in September, and then crashed. Okay, so we're following, nothing's ever exactly like anything else. I hate overlaying one chart with another chart, expecting the same exact thing. Never works out exactly. But we have something, history rhymes. So this year, the TLT T-bond ETF is down 22% since, I think, March. And it looks like it may have bottomed last Friday. Okay, so what the thing that would make a crash happen is a major asset allocation shift out of stocks into bonds. So, and when the consensus is super hyped up and bullish on stocks and overloaded, when they get squeezed and then all of a sudden push the sell button, and then bonds start to rally, you get this huge gyration where bonds go up and stocks go down just because of asset allocation flows. And I think we have the potential for that. I'm not standing out here saying the market's going to crash. It could potentially happen.
When could that potentially happen? Tomorrow or April?
Soon. So here we are in early, Friday the 13th, right before a solar eclipse on tomorrow. Not that has anything to do with anything, but I think it's setting up for that. And basically, it has to do with sentiment. Another one of my clients, big hedge fund, all they care about is sentiment. When people are too bullish or too bearish. And I just think, I don't get it. All right, so a little digression here. So the definition of psychosis is when you think you're the only smart person and everybody else is crazy, right? That's kind of, I worry about that because that's what I think. I think everybody else is out of their minds after 19 months after the Fed has started tightening, the money supply is shrinking, and people can't get enough stocks to buy. Hello? Where have you ever heard don't fight the Fed? I don't understand where this ebullient, excessive exuberance comes from. I just think it's misplaced timing, misplaced from what's going on underneath the surface of the market. By the way, one other little point here. We went really in the Alpha Capture Fund and also in the Belkin report, I'm long defensive sectors, which nobody likes, which have been underperforming until this
Oh,
week.
they liked them on Monday. They were up
Yeah, well,
10% on Monday.
but
Are you talking
again,
defense stocks or defensive sectors?
No, defensive. So
Oh,
I'm
okay,
talking
okay.
like utilities. So
Okay,
things that
okay.
nobody wants to touch with a 10-foot pole. Anybody that's really bullish on the market, utilities, forget about it, right? Like they wouldn't even think about it. Okay, so utilities up 4% this week, with the S&P up 1, so 3% alpha. TLT, the T-bond ETF, up 3% this week. It's outperformed the index by S&P by 2%. Here's another one for you: GDX, gold stocks and gold. So gold's up 5% this week. GDX up 8% this week. That's up 7% more than the S&P. So we're getting this risk off move into defensive stuff: GDX, utilities, and bonds, and then the VIX. You probably want to. We're going to talk about that.
Yeah. Let's talk about the VIX. So you are expecting a higher move in the VIX, or a move higher in the VIX. Is it largely due to expected recession expectations, or what are the factors you expect in that?
Okay, so my model gives direction, position, intensity. It's a 12-period forward forecast based on my studies of Fourier and Box-Jenkins in the UC Berkeley statistics department and the business school. Nobody else was looking at this stuff when I was doing it.
Yep.
And I was not happy with what I learned in econometric forecasting. It wasn't very powerful. So I developed my own algorithm. So that says direction up, intensity strong, position just starting. And again, it's another one of these things where the bubble people, as I call them, whoever they quote unquote are, love to bomb the VIX, right? Okay, so that's the market goes up, the VIX goes up, out of the woodwork comes huge selling, and they knock the VIX down almost every time until that right tail kicks in. All of a sudden, the VIX is not, they can't do it anymore, and then the VIX goes up in their face, and the vol sellers get squeezed out of existence. So I think that's the potential where the VIX could go up. So when it's down, by the way, options are cheap, and this is very complicated, and I don't have all the answers. So now there's these 0-day options, right? And people the institutions are selling those things, and retail investors are buying them. So option selling tends to depress the VIX, and option buying tends to increase it. But options are still relatively cheap. So I would say like put options on the NASDAQ, which I think is like 20-30% too high just for starters. I like put options on QQQ, put options. I think they're cheap. I think it's a good entry point. I think the index goes down, so the value of the option goes up, and the volatility goes up, so you get a double kickers. Is it going to happen this afternoon or today, tomorrow, or next week? I don't know, but soon. I think it's setting up for that in the model forecast.
Fantastic. Albert?
I like that. No, I like his idea. I mean, I hear people trying to, short the 2 and 10 year, which I think is lame trade, to be honest with you. If you think the 10 year is going to end up going to 5.5% to 6%, you might as well just short NASDAQ and some of the tech stocks. I mean, as you get more juice, doing that. Michael's right. I don't really see how this market can stay so elevated with so many just policy errors and bad sentiment out there. It's just crazy to me.
So given the policy errors, and I know we've talked about this a few times in the last couple of months, but it seems to me also that what both Michael, you, and Albert are saying is that a lot of these companies, their margins are really compressing. Is that part of the reason you're seeing this rotation into these other segments?
Is that me, Tyler?
Both,
So the only thing I have about margins and earnings is, inflation does inflate earnings, right? At least with the headline numbers and temporarily. But I just don't. Like I said before, margins are getting tight, and wage inflation is getting out of control. So it's an inevitable thing historically that you're going to see this market retract to something where it's fair value, whether that's 3,200 or 3,900. I don't know. I can't answer that. So out of my league.
Okay, so margins are one thing, but top line is another thing. Okay, so And in my scenario, so we're moving into earnings reporting season, right? And the banks were supposedly good today. But if the economy is going to do what I forecast it will do, then we're going to see warnings. So basically, in the rearview mirror, it shouldn't be too bad. Q3, right? You can say, good, it's okay, worked out great, blah, blah, blah. Look at going forward, I think it's going to be bad, okay? And, and the way this works is the companies say it's not, we're downgrading our forward revenue, our sales are going down. So you can see it across the board in retailers, industrial companies, things like that already. It's not so much tech stocks yet. But if they say, well, all of a sudden at the end of Q3, beginning of Q4, our orders started to fall. Then you get these Wall Street analysts downgrading the stocks. And then you get this Pied Piper thing, where all these long-only managers that only listen to Wall Street analysts and consensus earnings forecasts all of a sudden say, oh, you mean Micron semiconductor sales aren't going to be that good? Maybe I should sell. So you get this snowball effect, right?
Sure,
where the brokers announce, the portfolio managers start selling, and then it turns into this snowball kind of thing. And one final point on that. So today, somebody mentioned this in passing, consumer sentiment down from 67.3 to 63 in early October. So that's sort of an anecdotal evidence of what's happening. So when consumer sentiment falls, willingness to spend falls. And if you look at the rate on car loans and house loans and stuff like that, forget about it. So I'm also short home builders. Home builders had an enormous rally. They rolled over a month or two ago. They're declining. Automakers, they're not the greatest short. They're not up a lot. I would prefer to short something. But anyways, the point is the financing costs for house and auto sales are off the map. It's unaffordable for so many people now, right? Particularly subprime lenders. So that feeds into the financials, the banks. So we heard, JP Morgan, Citibank, and Wells Fargo today were okay, earnings supposedly good. Well, let's wait until we hear what's happening with the regional banks, which are short for me. So I think that we're in for another round where the regional banks start going down, liquidation. They start warning of loan losses, deposit outflows, all the same stuff as last time.
Okay. So we have geopolitical risk, rising geopolitical risks. We have rising market sector risks. We have risk with kind of a Fed mistake. Sounds like kind of a lot going on out there. So, Michael, this has been really enriching, just hearing how to apply this broader stuff within specific market segments. So, guys, I really appreciate this. You've really helped us sort through a lot of the noise and action this week. So thanks very much for all of this. Thanks, guys. Have a great weekend and have a great week ahead. Thank you. Thank you.
That's it for this week's episode of The Week Ahead. Please don't forget to rate us and review on whatever platform you are watching or listening to this. Thank you.